Right. Good morning, everyone. We will get the webinar started in about another minute or so as we have folks joining in. Got a few more people coming in here. Give it another 30 seconds or so. Now. All right. Well, good morning, afternoon, everyone, wherever you are in the States here. Welcome to our user Q&A webinar today on the Tax Center, the Income Lab Tax Center, specifically looking at account types and distribution strategies. Before we kick it over to our two presenters, Derek and Justin, two householding items for folks who are new to our user webinars. We will have a presentation to start off, and then we'll open it up for Q&A. You'll see in our Zoom here that there's a Q&A section in which you can drop all your questions there. Please keep a lookout for other folks' questions. You can like and move that up on the queue. And then once we open it up, we'll just work through the queue and make sure we get all the questions answered. And for our folks who have been joining our webinars regularly, our next one coming up on April 12th, we will actually have CFP credit available for that one as well. So you will also see that announcement come out tomorrow. And I'll actually drop the link in the chat here for anyone who wants to go ahead and register for that next webinar as well. Outside of that, Justin, Derek, glad to have you guys back again. I will turn it over to you.
Okay, thank you, Mackley, and thanks everybody for joining. I apologize for my voice if you notice it's a little hoarse. When you have 3 kids under 6, you catch everything within about 100 miles of you. So, we'll get through it. So yeah, today we're gonna spend some time talking about the Income Lab Tax Center, and it'll be a mixture of some kind of higher level thoughts and some very specific kind of, how to use it, going over some settings and things like that to make sure that, people kind of can see the power and customization possible with kind of the tax engine in Income Lab, and maybe that'll spur some questions as well. So let's get going. Quick outline of the presentation portion for today. We'll do a little bit of talking about kind of the whys and hows of tax planning and retirement. So this will be a mixture of high level and also a quick kind of overview of the tax center in Income Lab. And then we'll talk about some trade-offs in retirement tax planning. So I think, one of the overarching themes of a lot of these webinars has been that there really is no such thing as an easy to follow rule of thumb that applies to everybody. So this tax planning is no exception. It's also a place where customization and really getting to know a client situation and helping them through that adds a lot of value. Then we'll talk about some of the inputs, especially focusing on account types. And we'll close up with some thoughts on where retirement tax planning adds the most value, what sorts of situations. So first of all, there's sort of a couple ways to look at this. You can kind of look at it from the perspective of the clients and the practitioner. So for clients, tax planning is a place where really it's almost impossible to do tax planning on your own. So tax planning is extremely complex and it requires expertise and also tools like an Income Lab to handle all of the complexity. But on the plus side, the long-term benefits can be substantial, at least for some households or many households. And the potential benefits are quantifiable. So we'll see a little bit of that, but that's always a nice mix where, substantial benefits can be quantified so that clients can kind of understand what the potential advantages of a particular strategy could be. For practitioners, we're going to be discussing this, but there is actually a fair amount of art in tax planning. It seems like it should just be very, black and white, do the math. And there is a lot of that, but there is some art and kind of understanding client preferences as well that we'll go through. And as with so much in retirement income planning, this also requires ongoing monitoring and updating. So this is not a one and done, send a client home with a 100-page ring binder to follow the plan the rest of their life. It's really part of an ongoing service. And as I just said, not one size fits all. Okay, so why retirement tax planning? As I mentioned, it's extremely complex, and I considered making an incredible flow chart showing which things affect other things, but it's almost too hard to do and visualize. So what you see here is just a little bit of what goes on in tax planning. So we need to understand the timing of cash flows, for example, Social Security, pensions, when do they start, and so on. The characteristics of portfolio distributions. Are they taxable or tax-free? Are they, investment, maybe long-term cap gains and so on? Are there RMDs, because those things can't be rolled over into Roths and so on. And then all of the interacting parts of the tax code. So ordinary long-term cap gains actually interact with each other because cap gains are kind of stacked on top of ordinary income. So security taxability is affected by all of this. Medicare, IRMA, state income taxes have, in many cases, a lot of complexity surrounding retirement income types. So this is just a little bit of a picture of why this is not kind of back of the envelope material for most people, even somebody with a relatively simple situation. But that being said, it is possible, and we make every effort to make this value easily demonstrable. It's quantifiable, and in this example, which is I think a household with about $3.2 million, kind of in the early 60s, for these folks, it could be substantial, right? We're talking about well over $500,000 in total tax savings over time, taking the effective rate from 19% down below 12%. And we'll talk about this in a second, but the way that this household would do that would be by engaging in Roth conversions early in their retirement. So this happens to be one of those households where tax planning, can potentially have quite an impact on the long-term experience. But although that's a very nice, neat picture, it's important to remember that it's also going to be necessary to update this plan at least annually. So typically what you might do is take a look at things early in the year, which have estimates for what the actions for this year are. And then toward the end of the year, if the household has a lot of variation in its taxable income, maybe they have large taxable accounts, and so the amount of realized capital gains and dividends and things are not knowable ahead of time, you would reevaluate that. But as you can see here, there are other things that can change as well that would require ongoing updates. Things like changes in the tax code, right? So on the upper left, you just see the top federal marginal rate. Over time, you see that it's changed quite a bit, a little less so recently, but obviously when there are tax code changes, it's time to update things. It's possible that the household makeup changes either through death, divorce, marriage, and so on. And so again, there's a need to change there, not just for tax purposes, obviously, also for broader income planning purposes, but taxes are affected by your status as well, right? Single versus married. And on the bottom, you just see changes in dividends over time. Again, for those with taxable accounts, that's going to be something that requires kind of ongoing monitoring. and management. So how does Income Lab help you with this kind of complex but valuable task? Well, we have three broad categories of tax distribution strategies that you can model. The first is pro rata, which is, I guess, our stand-in for don't pay any attention to taxes. So it's a good kind of baseline to look at. It just involves taking withdrawals from investment accounts according to that to the account size, right? So larger accounts will have more withdrawals. Next, we have tax ordering. So this involves withdrawing from accounts of one tax type, say taxable accounts, until that account type is exhausted. So until all your taxable accounts are exhausted, then moving on to the next one, let's say we're tax deferred. So now it's our IRAs, 401ks, and so on. Note that in all of these cases, we're always including RMDs at 59.5 rules and so on, so behind the scenes, right? So that those can have an effect here that would change exactly how much money is coming out of which sorts of accounts. So for example, in tax ordered, you might be trying to take taxable distributions, but if there are RMDs, those would be taken first. And if they're enough to provide all the income needed, you may not have taxable withdrawals in a given year at all because the RMDs take precedence. And then finally, bracket management. So this is maybe the most complicated one, and it's the only one that includes Roth conversions. So what's happening here is we're withdrawing the funds needed to fund the lifestyle in a taxable, tax-deferred, tax-free order. And then if that, along with any other income, maybe Social Security, pensions, rental income, so on, if there's additional space left in the bracket that's specified, and here we're talking about federal ordinary income tax brackets. If there's any space left, we will figure out how much of a Roth conversion would fill up that space. That can be fairly complex because adding Roth conversions can drag other money into taxability, things like Social Security. So it's not a trivial calculation. So that's how the three sort of types of tax management strategies work. Now, each of these, other than pro rata, actually have kind of subtypes, right? So you can go in order to set these in the software. There are a bunch of places that you can do it within a plan. So if you're not in the tax center, you would go to the advanced settings and choose your tax strategy. And then once you've chosen a tax strategy, for example, if you have tax ordered, you'll see three kind of cards that you can drag around: taxable, tax-deferred, and tax-free, and you put those in order. If you choose bracket management, you'll be asked which bracket you're trying to fill up. You'll also see it in the tax center in a couple of places. If you hit edit, you'll see a list of all the tax strategies. And actually, you can even apply a tax strategy to a particular plan. You can say, hey, this plan is planning to do this tax strategy, by clicking apply strategy to plan within the tax center. So that's just as kind of a way to not force you to go from the tax center back to a plan, go into the advanced settings. So it's just a shortcut, basically. And then within the tax center, there are two sections. And I'll actually go ahead and give an example here. But there's a way to compare strategies. So among all of those available strategies, you might want to put two of them side by side. And then there's a way to explore them. So I will queue up an example here for you. So for example, here we are comparing bracket management to the 32% bracket to taxable, tax-deferred, tax-free. By default, this is always the compare to, the strategy to. The reason for that is this is kind of the most commonly seen rule of thumb for tax planning. But you can change which these are by hitting edit and changing either strategy 1 or strategy 2. And you can see all of the strategies with their summary statistics here as well. Now, in this case, at least from a tax perspective, the thing that is projected to have the lowest total taxes is bracket management, so the 32%, but we'll talk about reasons you might want to explore some of the other options as well. But you see, this is probably our most popular view for talking with clients, right? It's kind of summarizing estimates over the entire plan. Average tax rate, total taxes, net income, and so on. But you have lots of other options, including looking at total taxes. So this includes, by the way, federal and state. Marginal tax rate, this is just the federal bracket, and break-even point. We'll be looking at these again soon. And then maybe a client found those compelling. The next step might be, well, what would following this strategy look like year over year? And that's what the Explore section is for. So go back here, go to Explore. And by default, it's going to pull in whatever you had in strategy 1 in the compare section. And now you have a year picker showing each year projected amounts of income categorized by its type. So, we have ordinary and long-term cap gains income. You can see here extremely aggressive Roth conversions all the way up to the 32% bracket. Again, pretty easy to just edit this. Maybe you say, 32 is pretty high. Let's check out 22. Many more years of Roth conversions in this case. Obviously, it's going to take longer to exhaust those Roths, but you can see now our Roth conversions are much lower as well. You can click through the years. So maybe I want to look at 2027, if it's a particular age or something, see what things are looking like, or look at the final year of projected Roth conversions. And we'll always see the details. Or you can see a given year's projected action. So in this case, we have withdrawals of 138,000. We're putting 107,000 of that into the Roth, so not all of it. And we're also supplementing with some taxable withdrawals. But we can see each year's details in a table format as well. Okay, so I want to turn to another kind of software tip here that sometimes comes up in talking about taxes. So Income Lab allows you to do income calculations in 2 different ways. You can either sort of ask, hey, how much can I afford? And that's by telling the system all about your financial situation, cash flows, investments, and so on, along with preferences for income risk. Basically, your preference on how likely you would like it to be that there's an income cut at some point, right? So that's income risk. You can also define how much income you want, and the system will figure out the income risk. So this is called solve for this income. Now, this actually does have an effect also on how you do tax calculations in Income Lab. So for tax purposes, kind of the how much can I afford approach does gross to net tax calculations. If you click solve for this income, it does net to gross. Now, both of these are useful for a variety of things. And if you're doing in-depth tax planning, the typical way to actually run the system would be to start with the default, the gross to net, get a feel for how much income this household can afford, and then put that in as desired income, do a net to gross calculation, and see how that affects the overall plan. Typically, it does affect it somewhat. I've seen it go in both directions, actually, in terms of risk. Maybe once you do solve for this income, if maybe you're doing an aggressive Roth conversion strategy, I've seen that actually decrease the risk. I've seen it increase the risk slightly, but that's a typical way to kind of, if you're doing in-depth tax planning, to use that solve for this income possibility. And you see here some summary on kind of the positives and negatives of both. So when you're doing this kind of tax planning, which is so complex, there really is no kind of single way to just get an answer right off the bat. Okay, so let's turn to some of the trade-offs in retirement tax planning. As I said, it's a little bit of an art as well as a science. So, for example, let's say we have a plan where the projected lowest tax approach would be bracket management to the 24% bracket. So large Roth conversions, which will mean large tax bills early on. This kind of goes counter to what it's a little bit of a delayed gratification situation, right? So we're asking someone to kind of rip the Band-Aid off early on in exchange for a high level of control over their taxability later on. And so again, this is not just about, well, what's the total number? It's a little bit about what are the other preferences for the household. So for example, some clients may not be able to stomach this kind of ripping off the Band-Aid approach, whether that's kind of purely an emotional aversion to paying high tax rates or based on some other preference. And so there are actions you can take when exploring approaches here. We already saw that you can explore, in this case, you could explore bracket management at a different level. We have 24% here, but maybe we want to go down to 22 or even lower. You can also set a Roth conversion cap. So maybe you've discovered that there's sort of an appetite for Roth conversions that at some point is exhausted. And maybe this household is only willing to do, $100,000 a year. You can set that cap by going to the advanced settings of the plan and putting it, you see down here, enforce annual dollar cap on Roth conversions. Set that amount. That's an inflation adjusted amount. Note that you can do that no matter what the plan itself has as a tax strategy. So, if it is doing Roth conversions for the plan itself, that will obviously apply. But even if it's not, the system will apply that cap in the tax center. So when you go to the tax center and explore or compare Roth conversion strategies, bracket management strategies, that dollar cap will be applied in that case. There's another sense in which this is a little bit of an art, not just a science, and that's that although total savings certainly matter in the statistics that we saw, so does the time frame. And so we have this break-even visualization, which is just the cumulative estimated taxes over time and the point at which those cross. So in this case, we see bracket management, the cumulative taxes quickly rise, but then level off, whereas taxable, tax-deferred, tax-free rise slowly over time and eventually become quite substantial, in this case because of RMDs. But it's going to take until about 2045 for that break-even to happen. So that doesn't mean that this is a bad strategy or a good strategy. It's something to think about. Is 2045 a very reasonable time frame for this household? Some other things that can have an impact are the tax status of the heirs. So, it may even be worthwhile if this household cares a lot about their heirs' tax bills. It may still be worthwhile making those changes, even if they were to pass away before that break-even point. And if they're worried about changes in tax policy, maybe they have strong opinions about taxes being higher in the future. This break-even could be earlier. Okay, so let's turn to some tax settings. Perhaps one of the most important is the account types. So you'll see here a list of all the account types we have available. We are building a few more as well based on some feedback from advisors. But this is really important that you get the account types right for each investment account. And let's talk about some fine tuning that is also possible within account types. So if for some reason there is an account It would be a tax deferred account that you want to exclude from Roth conversions. So if for whatever reason you kind of want to set that aside, make sure it's not available for Roth conversions. If it's a traditional IRA or a simple kind of IRA, a SEP IRA, for example, you can just click exclude from Roth conversions on that account. If it's a retirement account, like a 401k, you click on employment and distribution settings and check exclude from Roth conversions, even if funds are available for withdrawal. Probably more common is getting things right in terms of separation from service and other special rules surrounding retirement accounts. So for example, whether that account allows in-service withdrawals if the person is still working for that employer, whether that account owner is a greater than 5% owner, because that affects RMDs. And in the case in which you've already separated from service, whether that person stopped working or separated from service in or after the year that they turned 55, because many retirement accounts have an exception to the 10% penalty in that case. Also, some more fine tuning. If you have a deferred comp account or an inherited IRA or Roth account, you'll want to specify the distribution plan for that account. It works very similar to what you might see in the tax flow section, but maybe you have, in the case of the deferred comp plan here, some installment plan. This was just an example. You'd normally expect that the next installment and the final installment are not the same. Inherited IRAs as well. So in this case, they have 6 years left, or maybe I guess it'd be 7 in this case, of kind of a stretch that they're doing, and in this case, it's annual distributions. So just as an example, you'll see differences in the tax center or in really throughout the system based on these settings. So if a 401k, for example, if the owner is currently age 57, but they separated at age 55 plus, you'll see right away they're having Roth conversions. In this example plan, this 401k is the only possible source of Roth conversions. But if they're currently 57 and not separating until age 62, you're not going to see any Roth conversions available until 2027. So again, this has a huge effect on the calculations and the possibilities. So when do we tend to see tax distribution planning yielding a lot of value? Well, kind of like I was saying, there really aren't good rules of thumb in most things, because client situations can be so particular and idiosyncratic. It's a little hard to kind of set hard differences here, but typically there's more value earlier in a plan or younger versus older. Maybe this is obvious, but larger tax deferred balances will tend to have more of an effect if you're looking at Roth conversion. And typically, if it's possible to defer certain types of income, Social Security is the obvious one, where deferral also increases that income amount. But in doing so, you make it more attractive to do Roth conversions early on, because you're not dragging Social Security into higher taxability. So that would be in contrast to taking Social Security, or maybe there are pensions and things earlier. So as an example, I ran a household at age 62 and another at age 70. I kept their account balance the same, but I sort of cut off everything in the case where they're 70 that comes before, and you can see the effect here. Now they do still have a few years before RMDs in that case, because if they're 70 today, they wouldn't have RMDs until 72. But you can see a pretty substantial decrease in the projected value of Roth conversions over time. So with that, I think we'll open it up to some comments from Derek, if you have kind of your thoughts on this, but also in practice, how you found the tax center to be useful, and then we'll go to questions.
Yeah, for sure. I think for me, this has really been, demonstrating the value generally of these tax planning strategies. has really been a focal point for me as I'm going into meetings with new potential clients. It's a way, anytime you can actually try and quantify something. That's what I love, about tax planning, is that in theory it's more quantifiable than, say, trying to convince somebody that your investment strategy is going to be worthwhile long term. And so many advisors are perhaps maybe it's compliance for other reasons, they're really afraid to have these long-term tax planning conversations. Like, I still make it very clear, I'm not a CPA. These are rough strategies. We're always going to want to fine tune this, get the tax professionals involved, make sure we're not overlooking anything, but trying to get that long-term strategy right. And for me, that's been a powerful way. Just to give one example, it wasn't too long ago, I was on a meeting with the client for first plan presentation meeting. They had one, I think it was about $500,000 of potential tax savings from getting that strategy right, the Roth Conversion strategy. And they said to me, if we get this one thing right, that basically pays our fee for a lifetime of working with you. I don't set it up that way or pitch it that way, but to me, it made it click that they could understand the value that was there from getting the tax planning right. That's not even opening up the door to the rest of the financial planning and getting the income plan on track. So for me, it's been a big part of what I'm doing and presenting to clients and prospective clients, and really just trying to make sure that we can quantify that value. And the tools here have been very helpful. I would say, like kind of as is illustrated here, as you get more experience doing these types of analyses specifically, you will see things like, the longer you make that kind of that valley in tax rates that forms as somebody retires early, has until age 70 with Social Security, 72 with RMDs, to kind of fill up that valley with Roth conversions. You definitely see there's a lot more opportunity there. So it sometimes makes retiring early nice from two perspectives if the plan otherwise works. So yeah, it's something you pick up on. And the other thing is the break-even age. That's been a really helpful. I have some other tools that I use in looking at tax planning. Income Lab's the first tool I've seen that gives me the break-even point that I can actually look at it. And it's definitely given me some scenarios where I say, yeah, you know what, the break-even point is 95 here. What the chances at your age 95, the chances that that's actually going to be that meaningful to you may be small. And I've had other cases where the break-even point is really young. And so it's a really valuable piece of information that I found useful.
Derek. And now we will open it up for our Q&A section. I see we already have some questions in here, so I will start reading them off and we'll get going. Let's see here. First question. So in a tax bracket management strategy, does Income Lab identify the source of funds to pay taxes on the Roth conversion and the quarterly estimated taxes that will be necessary in the following year?
So it does identify the withdrawal source. So in terms of taxable, tax-deferred, tax-free, I mean, if it's a Roth conversion, it's unlikely it's a tax-free source, but it would first preference paying for those with any non-portfolio funds. That's relatively rare, but if somebody maybe were, still working or had maybe large, I guess this would be portfolio, but maybe some non-qualified deferred comp or something, then it would pay taxes with that. Next, it would pay it out of taxable accounts, and finally out of tax deferred accounts. In that case, that's one position where you would see the amount withdrawn from tax deferred accounts is not the same as the amount that's going into tax-free or Roth accounts. I mentioned kind of the normal workflow of, starting with, sort of the default way of running the program, and then really narrowing in using the solve for this income. That's a place where that's particularly useful because it will get you those estimates. As for the amount of estimated tax payments, no, that's not part of the platform currently. There is the estimated actions section that I was showing earlier. can be used, and you can even export this as a PDF. Sorry, I clicked on the wrong. And sent with the client to a CPA, or maybe you have a CPA that you're working with to kind of dial in those numbers and set a little bit of a plan for the following year.
This is kind of a follow-up question, but more for you, Derek. It says, Derek, since Income Lab doesn't currently have a table that details what specific accounts are being withdrawn from to produce the monthly income, how do you communicate the specifics of what accounts are providing the monthly spending? For example, when doing a Roth conversion, you might see additional withdrawals from taxable accounts to pay lifestyle and the additional taxes owed.
I mean, just in general, I try to keep things very high level. When I'm talking about where funds are coming from, I am generally talking in buckets in terms of like taxable funds, tax deferred or tax free. I try not to, just personally, my preference, like that's the level I'd like to communicate at. Obviously, when it comes to actually doing that analysis, which account are we going to pull from, getting that level of detail, it could, many different factors could influence that. But so I guess my answer is partially, it actually kind of works in terms of how I prefer to communicate that level of depth. Then getting into the details, like year to year, I'm also using other tools like Holistiplan is a tool that I use quite often. So, I've already have a copy of the client's tax return, have that uploaded in, using kind of the general strategy here, the long-term strategy, taking that into a different tool, dialing in those numbers, getting a little bit more precise. And then of course that still doesn't answer the specific account question, but that's kind of the next tool, and it's outside of Income Lab, I guess I would say, where I'm doing those fine-tuned steps to get to the actual action of where to pull those funds from.
And this is an area that several advisors have asked us about, kind of a getting down to the account level implementation of these plans. So it is something that we're exploring as a possible offering in the future.
Next question is there any intention to add the ability to simulate a single Roth conversion? That is, how much would the client benefit if they did a Roth conversion for this year only, as opposed to doing them every year?
I have not had that request before, but it's an interesting one, kind of saying, hey, just do the whole thing, right? Which would allow you to get, well, you can't see it here, but up into the 37% bracket, for example. Yeah, happy to take that on board. That would not be particularly difficult to add as one of the strategies.
I might quick add to that, just my own thoughts. Like I can see where, the big long-term strategy is good to have. I think it's also sometimes overwhelming for the client, right? Like year by year, we just want to do one thing. So I could see the value, not even necessarily of like the whole. I mean, maybe you want to try and look at the whole conversion, but the question might have been getting at to like just what's the value of converting $50,000 this year, to put something to it. And I could see the value in that, because then I can go to my client and say, yes, we've got the long-term strategy. This year, we think 50,000 is the right number. Here's the value. That's going to cause long-term, and just kind of focus that conversation in on the narrower. I'm not sure if that's what the question was getting at.
That makes sense. It wouldn't have to be the whole thing. So no, that's a really good question. We've also had a request, which actually we do have in our product roadmap, of, specifying maybe a window where you're not doing Roth conversions. There might be reasons that you wouldn't want to do Roth conversions in particular years. So that's been a request as well that I can definitely see the value of.
And next question, I think still kind of on the lines. When the software considers the money needed for spending first to determine bracket management, is it looking at proposed income or budgeted expense items?
It's looking at proposed income. So now you can make those equal, by either hitting solve for income or just having dialed it in already. But yeah, it's looking at proposed income.
Perfect. And Derek, to your last thing, we just had a few users kind of reiterate that being able to illustrate one or a couple years of that Roth conversion would be useful. And then next question. So this is about the bracket management module. The tax center might show, for example, that it is optimal to convert 24% up to 24%. But when you run the plan and look at the total monthly income, it goes down. It would be nice if the tax center worked with the income projections to come up with the scenarios that would produce the most recommended income.
Yeah, so that's what you're seeing there is the difference between the gross to net and net to gross approach. So as I said, typically as you're narrowing in on a particular approach, you'll want to switch to solve for income, which is going net to gross. So what you're seeing is perfectly reasonable if taxes are low. You know, maybe you're making $100,000 and you're netting 95. But if you have a lumpy tax plan, then that's not going to work. You know, we're not going to go 100,000 gross, 10,000 net in the first 3 years, and then 90,000 net following. So that's where you want to use solve for income, which will gross up instead of netting down the approach. So that'll solve that problem for you.
And the next question is, what life expectancy is used for optimizing the Social Security claiming decision?
So it's actually not, I don't believe there's anywhere where we sort of claim that there's an optimal claiming strategy for Social Security, but we do have a break-even age, which is just saying, hey, how long would you have to live for the foregone Social Security to have been made up by the additional Social Security that you've gotten because of deferral. So there's no actuarial assumptions in that particular calculation. We have kicked around the, kind of like the tax center. It would be interesting to have a Social Security center that really did take a lot of that into account and all of the complexity surrounding those decisions. But that's not the way the system works at the moment.
And this next one is a follow-up on the source of funds for tax payments on conversions question. Does it add in a capital gain assumption if the funds are coming from a taxable account?
It does, and actually that's a good, that's a section I skipped, but yes, right. Yeah, you can shift over to another account here, but each firm can set its own tax assumptions, and part of those assumptions are taxability of different kinds of gains for taxable accounts, and those are set by according to asset classes. So I'm trying to find an example kind of firm admin account I have here, but if you go to the settings, you'll see tax settings available. And then it is also making an assumption that anything you're withdrawing, so that's for kind of you could call it like passive income, right? Dividends and so on. Yeah, and I'm having trouble finding an example account to bring up for you. But then any withdrawals, it assumes there's pro rata amounts of gains and basis. So if 60% of the account, or if the basis is 60% of the current balance, then it will assume that 60% of the withdrawal is tax-free return of principal. So that's how the assumptions work there.
And the next question is the PDF reports from the report center don't reference what tax strategy is being used in the plan. Is that normal or will that change?
It should reference it. If you're seeing a particular page that isn't, definitely let us know. It should be saying which one is being used.
And then, I'm seeing we had some questions in the chat, so let me hop to some of those. Is there a way to see an impact on characteristics of legacy under different tax strategies? What is the mix of tax deferred, taxable, and Roth in Roth and under each strategy? Sure. So I think in the, if I understand the question correctly, I think in the, as far as looking at the legacy results on the tax strategy? Is the user able to see kind of what's left in the portfolio that's tax deferred, taxable, or tax free? I think that's the question.
Yeah, there is a portfolio kind of taxability view. Let me see if I can. So within the tax center, so in the explore section, if you go to portfolio, I suspect in this case it's all tax-free, so it's a little less interesting. But if we shifted to pro rata, for example, it's a mix. Yeah, so and you can see the tax deferred balance is going down faster than others because of RMDs. And then this amount is what for figuring out those legacy estimates, net legacy estimates. It's basically assuming a 50-year-old couple in the same state and complete, just taking everything out of each account and paying all the taxes.
And then this next one is comment or feature request. This user noticed still no features for charitable planning like gift giving, appreciated assets, or QCDs. If I remember, tax assumptions may use standard deduction assumptions.
They do, and that is very high on our radar in terms of some more ability to do specific tax planning, especially non-standard deductions, QCDs, and so on. So yes, thank you for your patience on that, but it's definitely a complex area, but we're definitely planning to add it.
This next one's a comment. It would be helpful if there was an HSA account type.
Yeah, I mentioned earlier, we're looking to add a few, and that is definitely one of them.
Perfect. And then next question, for Roth conversions, does the software consider the 5-year withdrawal rule before which Roth monies cannot be withdrawn? This should be Roth conversion by Roth conversion.
Right. So talking about, I guess both contributions and conversions, but that is not an area that's covered right now. If it's something that you really find would be useful, as you say, kind of in an account by account case, we could add it just as we do to say, exclude Roth conversions. We could ask when the 5-year rule will be up for that account. We actually do for simples, by the way. So simples have a 2-year, they have to be open for 2 years before you can move the money. So it would be very similar to the simple, except a 5-year.
And then next question is, does the software optimize in the tax center, optimize considering IRMA, Social Security taxation, and net investment tax?
It does include all of those. So let's see this example. Yeah, they do get into some Medicare IRMA late on because of RMDs in this case. They even get a little net investment income tax late on here. That's partly because their taxable account has grown, and partly because net investment income tax, the threshold is not inflation adjusted, so it's just going to hit earlier and earlier, or at lower and lower levels in the future.
And then next question in the chat here is, Does the software allow a 401k plan to avoid RMDs if the employee is over the age of 72 and still working for the employer?
It does. So that's why we ask whether they are greater than 5% owner, because that's, if you are, you don't get that break. But if we ran an example where one person was going to continue working with that firm for till 75 or 80, you would see that your RMDs would be much lower.
And then we had one comment asking if the slides will be emailed after. I think we can include that in the
recording, right?
With the recording, yep. Perfect. And then here it says, with large conversions, the proposed income in the income goal box can easily drop below the desired income. I know this is due to taxes that need to be paid, but how do you address this? It does not make sense to tell a client to come back on desired spending for the purpose of paying taxes on Roth conversions.
Yeah, again, I think what's needed there, and maybe we could even do a little more specific piece on this workflow. I without a doubt, connecting your dynamic income plan to a tax plan and so on is the most complex set of planning. So typically what you'll do is you'll start out without checking solve for this income. That will give you a feel for what the household can afford, and dial into, okay, this is kind of a net income level we're going to seek. Define that net income level and check solve for this income, and then that problem will go away. So you'll see that it will no longer be going gross to net. Whatever net happens to be, it'll be assuring that you have the right net amount of income.
And this next one, I think, kind of touched upon it, but maybe just make sure we answer this specifically. Does the tax model include the extra Medicare tax of 3.8% on married couples income over $250,000 a year, and or long-term cap gains?
We did touch on it, but actually, so here it is, the net investment income tax. We also include the extra FICA tax if you have earned income.
And then this is more of a comment. Sequence of return risks should influence Roth conversion strategy. Example, draw down a taxable account to pay the taxes. Does the system consider this?
It does. Actually, I had thought about including that in the initial presentation, but it would have made it a bit longer. So that's another one of those art and science pieces. And you're exactly right. There's a variety of things that increase your portfolio withdrawals early in retirement. One of them is Roth conversions. Another would be delaying Social Security or other income flows. And that's not cost-free. Sometimes it makes a lot of sense, but the cost is typically higher sequence of return risk. And you'll see that in a couple of places. Probably the most obvious will be right here in the income adjustment plan. Typically, if there is more sequence of return risk, then this kind of guardrail amount will be closer. So it will be more likely that you will see an income decrease in the future. I've played around a bit with this, and in a lot of the example plans I've seen, that is true, but not hugely so. It might be a few percentage points different, but I expect there are situations where it's substantial. I just haven't found them.
I might just quick add on to that I think that the whole art versus science, particularly for this topic, is really, really important. It's too easy to sometimes get caught up in the numbers and trying to perfectly model the exact scenario. And sometimes I've tried to do that, dug into it, tried to find workarounds, and then realized, take a step back, and it didn't have a big impact on the plan, or at least in terms of the high level outcome. Obviously, I understand. We all want the software to get it as perfectly right as possible, but that's an area where I've had to pull myself back a little bit, just in terms of asking, is this really going to move the needle too much if I get this particular accounts treatment of the RMDs perfect versus just getting the general strategy and knowing we're going to need to adjust and update as time goes on anyways.
Yeah, I think it's helpful to compare two cases. And then if the differences are not huge, like in this case, if I ran another one that had Roth conversions, then it was, I would see a decrease at 17.8 instead of 19.8. I might say, well, that's within tolerance. I feel fine about that. Or you could look at the plan test outcomes. That's another place where you see risk at play. So I think there are useful risk measures in the kind of main dashboard for the plan here, that where you can, make sure that a particular strategy doesn't just knock everything completely out of whack. That it's definitely useful in that sense.
Well, looks like those are all the questions. Actually, one just popped in. Any thoughts on rounding the income numbers, i.e., instead of 14,664, just 14,600? Yeah,
that's a common thing that Derek has been bugging us about. So it's definitely, I agree completely that this probably sends the wrong message with precision. People may interpret perfect accuracy. So that is a relatively easy change that's on the agenda. Yes.
And just in terms of, how you're actually presenting things to clients, a lot of times I'm taking information, especially with all the Zoom meetings I've been doing and things like that, and moving them into like a PowerPoint that has the key things I want to highlight. So for myself, when I look at the income adjustment plan, I'm just rounding some of the numbers to where I feel comfortable, talking about it. And that's my workaround personally to that. It's nice to have the precision, but at the same time, communication, sometimes it's, I like the round numbers.
Well,
thank you for the feedback. It's always really helpful to understand what would move the needle most for advisors who are using the software. So we really will take your input seriously.
Yeah. Thank you so much, everyone, for the questions and for joining. This is any chance Derek could share a high-level workflow for you to build and test the plan? I like that idea. I think we could possibly do another webinar focused on that. So we'll note that for the future. But yeah, thank you so much, everyone, for the great questions and for participating. Justin and Derek, as always, thank you so much for taking the time to put these presentations together and to share the knowledge and help with the questions. For our users still on here, just a quick note that our next webinar will be on April 12th, and we did put the link to register for that webinar in the chat as well, but you'll get that link as well in the follow-up message. And that webinar will have an hour of CE credit available as well. So thank you so much, everyone, and I will close out the webinar for now. Take care, guys.
Thanks, everyone.